hoping we can get through it. I think we can. And then monetary sampling, I mistakenly put it in as do it on the 11th. It's back up to at least the 25th. So we're not done with that one. And hopefully we'll get through some of that tonight. But let's go ahead and go get started on the chapter 5 and 6. And again, I'm sorry I'm late. Hold on, in the wrong screen. Here we go. All right, so let's go to okay, so materiality. We have quantitative, which are dollar amounts. We're going to do that next, but we also have these qualitative ones, and these qualitative ones are for things that are not quantitative, but they're still material because of their characteristics, because of what they are. So there actually are two different things here, and it could be something that's not dollar material, but because what it is, upper management fraud, violates a contract, blah, 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 that could make it material. And so, and this gets me to a point. What's wrong with my? We have an earthquake here. I apologize. I guess it is shut. All right. Oh, so materiality. So here's the thing. When you're taking the CPA exam, especially if they tell you something is material or not material, you got to take it at their word. Because even if the dollar amount isn't material, doesn't mean it's not material. If the dollar amount is, let's say 5 million is the cutoff, if it's less than 5 million, it's not quantitatively material, but it might be qualitatively material. What it is might cause it to be material. So it's not just a dollar amount. It's also, we also pay attention to what it actually is that we're looking at that is misstated and why. And especially if it has things like reflecting on management, violating contracts, that sort of thing. We look at those things much more seriously because someone's going to be relying on the audit to see that those things are being followed, that, management compensation, violating contracts, reversing trends, making a loss into a gain or a gain into a loss or whatever. Those are all things that can make a small amount material. So again, back to the point. If a case says that it's material, believe it, it's material. Or if it says it's immaterial, believe it, it's immaterial. You're not going to go through all the, the quantitative and qualitative reasons as to why it's immaterial. But just believe it that it's material. So whatever they give you, believe it. They don't generally have you make those judgment calls. I might have you make that judgment call, but they don't on the CPA exam. Okay, so now we're going to see how do we actually establish kind of rules of thumb as far as what is material or not. These are not universally, every CPA firm does not use the same ones. And when you go to a CPA firm, they will have their own ways of doing it. So, these materiality benchmarks, these are things that are rules of thumb. These are ones you can use, but again, it really depends on the CPA firm using it, and virtually all CPA firms have their own kind of set of rules as far as how to do this. Okay, now let's look at, here's the percentages. So, and you can use any one or all of them to kind of get a feel for what's material. There is no one that's better than the other ones. All right. Now, when you look at these ranges, sometimes they're pretty big. 5 to 10%. Well, 10% is twice as much as 5, right? So it makes a difference where on the range you are. Now, here's the thing about when we do these percentages. We generally do them inversely to the size of the company. What I mean by that is the larger the company, we're going to hold it to the smaller percentage to be material. If it's a smaller company, we hold it to the larger amount of material. And there's a good reason why. If a company is making $100,000, and you say, okay, well, let's use this rule. At 10%, that's still $10,000. $10,000 material. A lot. You're probably not going to get sued over $10 million, or excuse me, $10,000. $10,000. The lawsuit would probably cost more than $10,000. So, the risk to the CPA firm are not as great for smaller companies. We give them a little bit more room. Conversely, when you talk about really large companies, and you're talking about billions of dollars, you have to really kind of tighten it up, because even 5% or 1% or whatever might be hundreds of millions of dollars. And yeah, you do get sued for hundreds of millions of dollars that are misstated. So, it's inverse to the size. So that's what we're going to do on this next one here to kind of show how it's inverse. Okay, so let's take company A, and we're going to use income before income taxes. We're going to use this one, the one we just talked about. So we're going to use this one. I'm going to change that to yellow just because it's easier to see. Okay, so smaller company, smaller client, we're going to use the larger percentage on this one. So when we calculate the overall materiality, we're going to say 150,000 times 10%. I just go like that. So the materiality for this one would be what? 15,000?
Yes.
Okay, let's take the other extreme here. Let's go down to company C. Big company or small company, or somewhere in between?
C or B? B.
So for C, I'm sorry, for C.
For C, big company. So 5%?
Yep, very good. Yeah, so we're going to take the larger percentage for this one because, oops. It's probably still going to be a pretty big number. Oh, what is it? Where's my calculator? The calculator's not turning. Oh, there we go. My calculator's turned off.
75,000?
75 million, maybe? Yeah, I need 75 million.
Yes, sorry. I
No,
put
I'm sorry. My calculator died. So, and again, like I say, if this one, $15,000, you're probably not going to get sued for that. You might, but when you start getting into millions of dollars, people generally, they will sue you for that. Okay, so this first one we use 10. Second one we use 5% because it's really big. Let's look at the company B now. Company B is kind of in the middle here. And again, this is where a judgment call is going to come in. What percentage do you think we should use for this one? It's not small, but it's not gigantic either.
5%?
Probably somewhere in between here. again, this is a judgment call, but probably somewhere in between.
7.
Sure, basically, yeah. There's no right or wrong answer to this, to be honest with you, because it is a judgment call. But probably like something like 7 would be okay. They're not the biggest company in the world, but they're also not the smallest. So we 5 million. So what is that? 3,500,000. Is that right? The 10% would be 5 million. I think this is right. I think it's 3,500,000. You may want to check that though. If it's not right, let me know.
It is right.
That's right. Okay. All right. So and so again, this is kind of, why is this, this rule of thumb, it's got a wide range. It really depends on the company that you use. Now, you could use any one of these, or you can, you could also use more than one and try to get a feel for it. Try to go to total assets or one of these other ones. The only time that it is kind of inappropriate to use some of these is if, for instance, the income-based ones, it could be that their income is very low or it's negative, and that makes it difficult to use these. The income one. Even so for instance, let's say you're doing the company that they still posted a lot, I can't remember. But anyway, so if they post a loss, let's say, or they have very low income, even though they're a large company, the rule of thumb might be really distorted for the size company there. Maybe it's a multi-billion-dollar company, but they have almost no income, or they have negative, they're running losses. Then you can't really do the income ones. Then you could go back to total assets or total revenue or something like that as your rule of thumb. But generally speaking, though, you can use any one of these. And again, as we noticed, these are judgment calls. Which one you use is a judgment call, or which any numbers of them you use. What range do you use? What percentage? Those are all judgment calls. And that's one thing about auditing that's really difficult, is everything's a judgment. Now, once you make that judgment, that it'll be in the work papers and everyone will use it. But coming up with these numbers is not as easy as it might appear. Okay. Performance materiality. Now, let me do something here. I think this is called performance. This kind of came out. This is a kind of a newer term, but I think this is for when you're performing the audit of individual accounts. Is used for the performance of the audit on individual accounts. So this is kind of saying, okay, well, we know our materiality in this case is the overall materiality we came up with from like up, like what we did up above is 200,000. How we got that, we're not going to worry about. But performance materiality says, okay, well, if I'm doing cash, notice the problem. If we say the overall materiality is 200,000, well, that it doesn't mean that cash can be misstated by 200,000 and accounts receivable can be misstated by 200,000 and inventory can be misstated by 200,000. We have to divvy this up so that when you're doing cash, you know when to raise your hand and say, okay, we have a material misstatement here. And if you're auditing accounts receivable, same thing. What's material to the material into the accounts receivable? These all can't be 200 off by 200,000 and be okay. because the total off would be, too much. Okay, so again, we might split it up and maybe cash. I'm just making these numbers up. Might be 100,000 is material for cash. And we're going to split this up between, let's see, accounts receivable, and we're going to split this up. We're going to assume there's only 3 accounts here to split this up over, just well, because that's what I put on the sheet from it. Okay, so of the 200,000, how much should we give to accounts receivable? We have what, 190,000 left? Again, there's no right or wrong answer, but somewhere between 0 and 190,000. Anyone? Again, there's no right or wrong answer. And if I do it, it'll be boring.
100,000.
Sure. So we'll go 100,000 on the accounts receivable. So what do we have to have for the inventory then? How much is left of it? 90,000? Right? There's 110. Yeah, I think there's 90,000. Oops, that's not the right. Oh,
We have 10,100.
Yeah, so this is kind of how we're splitting up the total of the 200,000. What am I doing? Give me a second to. So yeah, so this is the the overall. All these together will add up to the 200,000. So we're going to split up the materiality between these accounts. So if you're doing the cash account, it'll be right on the work papers. On the work papers, it'll say cash, materiality, $10,000. It'll be, probably somewhere in the lead page of it. You don't show that to the client, by the way. You don't talk to them about materiality generally. So anyway, but when you're doing cash, you go, okay, well, I have, there's $10,000 here. So if I come up with an error that's $3,000 and there's no qualitative, management fraud or anything like that, I know that it's not material. I will record it. I'll record that I found this, but it will not be in the suggested adjustments usually because it's not material. Go to accounts receivable, same thing. If it's not off by 100,000 and there's nothing qualitative about it, you will put it in the work papers. Everything is documented in the work papers. You will put it in there. The senior auditor will take a look at it and see what they want to do with it. Even though might not be material, they may still suggest that they make the change. But anyway, as you're doing that accounts receivable, you'll know that $100,000 is material, and when you're doing inventory, it's 90,000. So as different people, it could be different people that are doing each of those 3 sections: cash, accounts receivable, and inventory. They will know when to raise their hand and say, "I got something material here." So the materiality is going to be split up between them. You can't have every, if your overall materiality is 200,000, you can't have every account off by 200,000. You'll end up with it being off by millions or whatever. So you split up the materiality so that when you're performing the audit, you will know how much is material for each of those accounts. That's what performance materiality. So as you're auditing, if you're doing cash, you get 10,000, accounts receivable, inventory. Yeah. Okay. Types of evidence. This is chapter 5 stuff. And this is the kind of stuff you just know, whatever it is that you do use to back up your work papers and your opinion. And obviously look at documents. I think I told you observation is a good one. Observing people, asking people, confirming. We'll get to that in a minute. The best ones here are going to be the ones that you do yourself. So oops. So things that you do yourself, auditor performed most persuasive. So observation is one, you're doing it yourself, you're not getting it from somebody else. Confirmations, we'll talk about those. Oops. Recalculation, calculating the work for yourself. Performance. These down here are for sampling. These will be more persuasive. We talked about that already. The audit. Oops, what am I doing here? And notice some of these other things though are less persuasive. Well, actually, this one would be. But if you're looking at documents, you say, well, wait a minute, I'm looking at documents. I'm doing that. Yeah, but you're not making the document. Someone already made that document, and then you're looking at their work, basically, what somebody else wrote. So that is less persuasive. So it's less persuasive to see what somebody else wrote looking at the documents. It's less persuasive to talk to people. Now, you are going to talk to people because they'll give you some indication about what to look at. And, it's not that they're it's useless to talk to them, but you generally have to corroborate that. And it might get you started on the right path. Whatever they say, you go, okay, I got to corroborate that is actually going on. And, and knowing that you have to corroborate that is valuable. But doing things like scanning data and stuff like that, this is all stuff that is, it's not firsthand. It's not you doing it. So things that you do firsthand are more persuasive than other things. And it's especially things like documents. A lot of times documents, especially those that are made by the client, are not very useful unless you can back them up with something else. Okay. Assertions. I can't remember if we talked about these. I think we may have. Did we talk about these maybe in chapter 3? No, chapter 2 maybe. These are assertions that are explicit and implicit in the financial statement. Sometimes they come right out and say it. Sometimes it's implied that they are, that the management assertion is there. So for instance, occurrence. If they say that there was a sale, if they say that their sales were X amount of dollars, well, that's an assertion. They're saying that this occurred. Yeah, you might also look at completeness. Okay, are all the sales in there? When they give you the financial statements, it's assumed that all the sales are in there. And for the sales are real sales, that they occurred, and B, all of them are there. They're not leaving some out. So those first two are actually two of the most important ones that we have to look at in auditing. These two are, they're not the only ones that are important, obviously, but they're big ones. The other biggest one here is going to be that existence. Okay, so, but these are all things we look at. If we look at, for instance, rights and obligations, if we look at equipment, it makes a difference how they account for it if they bought the equipment or they're leasing it. So you may go out and take a look at it and say, okay, here's the equipment. I can see the equipment. Just seeing the equipment, while it is helpful, that it's there, does not necessarily mean that they own it. they may be leasing it, that equipment. So there is some rights and obligations. So that is one of the things we always look for is, are they, do they own it or not? And by the way, one of the ways you look for that is look for lease payments. If they're making lease payments, that could very well mean that they're leasing it. It could be a loan, and they own it, and it's a loan, that's different. Okay. So these are the AICPA assertions. The PCAOB has assertions also, and you'll notice that many of these, if not most of them, are duplicates. There's a few different ones here that are, but for the most part, they're duplicates. Okay, so let's say a substantive test plan for asset accounts. For instance, let's say inventory. That's just an asset. There's nothing special about it. So let's take an asset. Let's say, for instance, inventory. We're going to establish that the inventory exists. We'll go out and look at it. We'll make sure that all the inventory we look at is included in the financial statements, in the balance sheet. Once we do that, we'll make sure that they have the rights to the inventory. What I mean by that is there could be things that are on consignment. And it depends on what business you're going into, but there's a lot of things that are on consignment. Sometimes you'll see like they have racks of candy bars and stuff like that. Sometimes those are on consignment. When I was at US Steel, we had these big conveyor belts, and the people that supplied them, they didn't want to have to warehouse them, so they would give them to us, and we would warehouse them. And whenever we needed a conveyor belt, we'd go get a conveyor belt, and they'd come in and once a month and count up how many conveyor belts we took and charge us for them. And we didn't own any of those conveyor belts. We didn't own them until we took them and put them on the machine. Then we owned them. Okay. Determine that the valuation is appropriate. And I can tell you that that is a very important one for inventory. And appropriate financial statement preparation. So these are just, again, these are the same assertions. And I can't even remember how we used to memorize these. I can't remember what we used to say. But there used to be a memorization thing that we would do for them. But anyway, these are some of the things. By the way, inventory, things like valuation. If you're going to cook the books for inventory, doing it by count is kind of risky because people can go out and count and say, okay, you said there's 90 here and there's only 81. So a lot of times doing it by count is not the best way to cook the books. An easier way to cook the books is simply by changing the dollar amounts. Changing the dollar amounts for the invoicing and all that kind of stuff. Bump the price up. Looks like you have more inventory than you really have. And the count will be, accurate. Okay. Did I go over one page here? Something happened funny here. This audit plan should not be in the middle of the page here. It should be at the top. Anyway, transaction cycles. How to explain these? Transaction cycles are complete cycles for transactions. For instance, revenue coming in, collection of revenues, and all that kind of stuff. They call that a revenue cycle. Acquisition cycle, when you buy something, you buy it and you pay for it eventually, if it's done on account. There's all these payroll cycle, investing cycle, financing cycle. This is just simply a different way of breaking up an audit. So, for instance, some people might do an audit based on simply the accounts. Like let's say cash, they'll audit cash. Everything that goes into cash, everything that goes out of cash, that's what we look at. So we're auditing cash. Someone else, a different audit firm, may use the cycle approach. Yeah, so this is it's the same kind of thing, but it's done by cycles. Is classified a little bit differently. So, for instance, I just told you about cash. So, cash coming in, cash going out. Well, if you look at doing it by the cycle approach, you'll notice that this collections. These are cash. Disbursements are cash. So, even though they're doing it, they're still going to be doing the same thing, looking at the ins and outs of cash. They're breaking it up into an audit based on the revenue cycle, based on the acquisition cycle, conversion, all these other ones that'll go in there too. So you can have do an audit based on accounts, which by the way is what I used to. Actually, I think most CPA firms still do that way. You base it on the account itself. So you audit cash, you audit accounts receivable, and inventory and all that kind of stuff. So, but it's simply a different way of breaking it up. All the testing is exactly the same. The same testing that you do for cash for collections will be the same thing, that will show up in the revenue cycle when you collect cash. For disbursements, how when you pay people, same thing. When you audit cash, you will look at how they do their disbursements. When you do the purchasing acquisition cycle, you'll do the same thing. The disbursements for the cash, you'll look at how they do their disbursements for cash. So it isn't that you're not doing anything or that you're doing things differently. You're doing everything the same. It's just that they're doing it by cycle rather than individual accounts. And the idea being is that the cycle will probably give you a better overall, a kind of a big picture of what's going on for revenues. The big picture. Here's how you make the sales. This is how long it takes to get the cash back when the cash comes in, that sort of thing. So it doesn't necessarily say anything different. It's just it's a bigger picture view rather than simply looking at cash separately, like looking at accounts receivable separately and all that. There's pluses and minuses to both of those ways, but you can do it. And by the way, it's up to the auditor. It's a judgment call which one to use. Okay. I'm jumping ahead. I want to see how much more we got left to go. Okay, this is it might be close. Okay. Who owns a document? The audit documentation. I think we talked about this. The auditors do. It's the auditors. It's our evidence that we're going to use to back up our opinion. It's going to document all of this. All this will be documented. And again, we document everything. We're going to document our materiality. We're going to document our, all the decisions we made on risks and all that stuff. Everything gets documented. You're going to document, support for the audit report. Put that down here. Working paper review. This is working paper review is usually done by the managers. The audit partners. It probably done by another partner. And sometimes it's done by outside reviewers. So we're gonna be review. A lot of people look at the work papers, and everything on there must be documented. It must be available to for someone else to see exactly how those numbers came about. And they must come up with the same results, but not the same conclusion. So audit managers, audit partners, other partners, reviewers will all, outside reviewers will all be in there. I'm going to put it in here because I don't know if I have it later on. For the AICPA, they can be reviewed after the report is released. For the government, the PCAOB, they must be reviewed before so AICPA, it can be done after. So you issue the report, someone else takes a look at it, and we'll see if there's anything that needs to be done or cleaned up. PCAOB, they're a little more proactive. They say that you have to have this done before you issue the report. We're talking about big companies here, and we don't want goof ups. So it is possible, especially for these two down here, that they do it after. The audit partners and managers, they'll definitely do it before they issue the report. But for these other ones, you know, the people not related to the audit, it's going to be done, but it can be done after for the AICPA. It must be done before for the PCAOB. Isn't it? Okay, I'm going to skip these. I'll mention them briefly. You can take a look at them. They're important. You might get a multiple choice question or two on the CPA exam about these. But basically, the permanent file is for long-term stuff. You'll see that these are all long-term things. And the current file is, as you might guess, all for the stuff in the current period, and the current period only. So permanent file, long-term, current file only for this current term. Oops. Okay. I think we talked about this already. What risk? I don't know. Inherent risk. Inherent risk is the risk, oops, that a material misstatement will occur. And this is before we have any controls to catch it. So I'm entering data. You know, what is the inherent risk that a material misstatement will occur? And again, this is only for misstatements. This is not for actually, the immaterial errors, because immaterial errors will probably happen more frequently. I bring this pen up for $2 instead of $1 or something like that. That kind of stuff happens. It could be for programming or whatever it is, but so we're only looking for those things, the risk of something material happening. Let's see, which one of these are going to be low inherent risk and which one's going to be medium and high. Routine transaction, do you think it'd be a high inherent risk or a low inherent risk?
I think it's gonna be low because it's repetitive and probably since you do in something repetitively, then there's less chances of this being a high risk.
Yeah, exactly. And if it's the routine transactions, you do it all the time. Sometimes it's almost difficult for someone to do it incorrectly because it's a routine. So yeah, routine transactions is usually low inherent risk. Non-routine transactions. So someone buys services and they pay with stock, or services are paid for with stock. So instead of paying them cash, we give them stock.
I would say it's medium.
Probably, yeah.
Stock, yeah, just trying to figure out how much would that go for, but still you can make estimation pretty accurate with stock.
Yeah, and notice that there's going to be while there's some risk to it, there's also going to be two parties, and so whatever the price that they agree upon is probably going to be, it's still not as good as say cash, but it would probably be a little bit more risky, obviously, that something good it could happen. Estimation transaction, depreciation, bad debt, etc.
I think it's also medium.
Yeah, probably. I mean, whenever you estimate something, it's going to be a higher risk. But again, these are often somewhat routine. Depreciation, we do depreciation every year. Bad debt expense, we do that every year. So while these are routine transactions, they are estimation transactions. So they probably are a little higher. We don't have a crystal ball. We don't know how many years this piece of equipment is going to last for. We don't know who's not going to be able to pay. There is a higher risk, but it's probably not the most. Complex transactions.
This is gonna be high inherited risk.
Yep. Happens very infrequently, usually, and also you're dealing with all kinds of estimations and non-routine things that you're going to be doing. For instance, a routine transaction, you're buying inventory through your vendor. You buy a merger like with a competitor. It's not an arm's length deal. You're buying their inventory. It's not like going to a vendor. You have to assign some kind of a value to them and that sort of thing. So there's going to be a lot of things that can go wrong here. So yeah, complex one. So this is kind of like how you usually kind of break up between what things you have to look at. So whenever you see a complex transaction, yeah, we say the audit ears go up. I worked with goofballs, amazing. Audit ears up. But anyway, but whenever you see a complex transaction, it means okay, you probably want to look at it because because your audit ears go up because it has a higher risk. Okay, control risk. Did we cover these before? I can't remember. Control risk. Risk is the risk that the clients controls will fail to identify a material misstatement. Oops. So the internal controls of the client, so this is not the auditor, the client will fail to identify material misstatement. So the first risk is, will the client, will they make a material misstatement? The second risk is, what if the controls fail to catch this material misstatement? Now, these two risks are assessed by the auditors. So inherent risk is assessed by the auditors, control risk is assessed by the auditors. In the true inherent risk and control risk, we cannot change the actual. Our assessment might change of it. We might think that it's more risky than it is or less risky, but we cannot change the actual inherent risk or the actual control risk. How do I get these on the same screen? Okay, so inherent risk, we will assess what the inherent risk is. How risky is it that we're going to, audit? If they had, for instance, if they had a merger, it might be more risky. If they didn't have any mergers, it'd probably be less risky. And control risk is assessed by the auditors. Now, these are actual risks, and the actual risks we cannot control for two reasons. First of all, those are under the control of the client. The client's people will record the transactions. And there's a risk for that. The client will control the internal controls. They'll have what internal controls they think are appropriate to catch those things. Also, though, if we're doing this audit at the end of the year, if there was a problem with, say, the control risk in March, there's nothing you can do about it now. Maybe in March they had some problem with the internal controls, and maybe it was cleared up by June or something, whatever it is. You can't jump in the time machine and go change that actual risk. That risk was there. So we only assess those things. We cannot change them. So they say, well, what can we change? The only thing we can change is this next one, and that's the audit word. What we can do is look at our assessment for the inherent risk, look at our assessment for the control risk. And then as auditors, we have a detection risk. And this is what we can change. Detection risk is the risk that the auditors, let me do something here. Detection risk will fail to detect a material misstatement. Now, this one we can change. We can audit to the 90% level or the 95% level. or the 99% level. You know, we can change that. What am I doing here? Hold on. My first time using a computer, so we can actually change the detection risk. So if we're concerned about something that is going on up here, we can increase. You know, okay, we were going to audit to the 90% level, but you know, there's this kind of crazy stuff going on. We'll go to the 95% level or the 99% level. So this one, the auditors can change this. This is the only risk the auditors can change. Changed or mitigated, you know, brought down to a reasonable level. So control risk and inherent risk, you actually can't change those actual risks. You can change your assessment of them, but it's actually changing the risk that you can't do. The detection risk you can. If you think something's more risky, you do more testing. You get more, you know, more evidence. Okay. Audit risk. Audit risk. The risk that an undetected material misstatement will appear. Do you get an financial statements. So an undetected, if we detect a material misstatement and we, you know, we'll audit our opinion appropriately. So this is when an undetected material misstatement will appear on the financial statements. This is an audit fail, basically. And the only thing we can do to try to avoid that is this detection risk. This is the only thing we have control over to control what the overall audit risk is. Okay. Do you have number 5 on the same page? Are these all on the? I don't know. We wrote too much up here. To get them on the same page. Yeah. Okay. Oh, I know why I did that. So there's actually a I don't know if CPA firms do this or not. I don't think I've ever seen one. The only auditors I ever worked with were Deloitte and Touche for both US Steel and Navistar. But there is a mathematical formula to this. That's inherent risk. Basically, all these things have to happen before the audit risk occurs to get the audit risk. So inherent risk in this case is 40 for the first one, times the control risk is 0.30. Times the detection risk is 0.20. And this will equal our audit risk, whatever that is. So get my calculator to work. I'll tell you what the problem with my calculator is, since I've complained about it a lot. It works, it's a solar one. So when the light goes out, it doesn't work anymore. Okay, so 0.4 times 0.3.
It's 0.024.
Okay. So the audit risk would be or was that 2.4%? And so, you're going to audit until you get comfortable, this detection risk is the only thing that we have to control over. So we're going to do our detection risk to try to get this down to a reasonable number that we can, okay, there's a 2.4% chance for audit risk, that's acceptable, or it's not acceptable. If it's not acceptable, then you got to increase your detection risk and get this detection amount down to, maybe down to 10 or something like that to get to a place that's comfortable. And again, judgment. Okay, sometimes you could also do this. They have had this on the CPA exam, I know, also. They'll say, okay, here's the inherent risk, here's the control risk. What is your detection risk going to be if you want to be 5% sure? And basically, it'll look like this. Should I do it underneath? All right, so let's see. So this is 50 times 40. And instead of 20, I'm just going to say that this is the audit risk, put a variable there, AR, and we got to get this down to 0.05. So what does AR have to be? Solve for that. I'm going to get more room up here. Okay. 0.4 times 0.5 is what? 0.2? So this would work out to be 0.2 times 8R. So let's see. I'll do it right here. So this will be 0.20 AR audit risk. Wait, I shouldn't say AR, I should say DR, detection risk. And we want that to equal 0.05. So we're going to divide both sides by 0.2.
Yeah, it's gonna be zero. I'm sorry, 0.25 detection risk. So quote.
I did this wrong. Hold on. I'm in all kinds of trouble here. Okay, so the detection risk will end up being
0.25.
0.25. Okay, so DR equals 0.25. So 25%, will be our, so we have to audit to the 75% level. You get it down to that. So, you just got to kind of put in the variable detection risk and then solve for that. Okay. Uh, inherent risk times, uh, sometimes I'll ask you for the risk of material misstatement. I haven't seen this a lot. I've seen it a couple times. What's the risk of material misstatement? The risk of material misstatement is um, the inherent risk times the control risk. So risk of material misstatement, I put right here.
0.12.
Yep. So the risk of a material misstatement will appear on the financial statements is 12%. Okay. If the client in C above engaged in financial statement fraud, how would the calculations change? Okay, so if they're engaged in financial statement fraud, what's the inherent risk? Well, they're going to intentionally misstate it. It's 100%. They're cooking the books. Control risk, well, they're not going to catch their own fraud. These all go to 100%. And this is the scary part about fraud. That's, for errors, it's not, what do I do? For errors, it's not as scary because these will kind of hold true, for errors. But when you have someone actively committing a financial statement fraud, these go to 100%. And here's the problem. If you wonder why fraud occurs and the auditors don't catch it, because they think they're here. They think there's a 12% chance when actually there's a 100% chance. And they're auditing, assuming that this is a 12% chance when it's 8 times that. Okay. If the this is the kind of a tricky question. If the financial statement fraud is suspected, how would the auditors change their detection risk? Raise the detection risk, lower the detection risk, or not change the detection risk? So that's this risk here, the risk that you'll miss a material misstatement. Are you going to raise that or lower it if you think there might be a fraud?
Oh, that's a good question.
So this is the risk that a material misstatement will not be detected. So a risk of a misstatement showing up. You want to raise that risk or lower it?
If the fraud is suspected, then lower the detection risk.
That's exactly right. You want to lower it down to 10% or 1% or whatever it is. If you suspect there's fraud, you're going to lower the detection risk. The risk of material misstatement is higher, but you're going to lower the detection risk because this is the risk that you're going to miss it. And the one way to remember this is you always want risks to be low. So you always want risks to be low. Given the choice between high and low, you want the risk to be low. So lower the detection risk. Let's stop here and let's take a break. I'm going to see if we can finish this or not. If we can't finish it, I'm going to go on to monetary unit sampling. I was hoping to get this done tonight. Okay, so let's stop. Let's say be back at I was already so be back at 7:19. Okay. And I'm gonna take a peek and see if I can finish this. If I can finish it, we might just go ahead and do it. If not, you know what? We're not gonna finish this tonight. Rats. Well, not rats. I mean, this is, I told you guys chapter 3 was like, 15-20% of the audit. This is probably another, these two chapters together are probably another 20-25% of the, I think the CPA exam for auditing. This is probably another 20-25% of it. So these three chapters, they cover a huge amount of the CPA exam, and rushing through them is probably not a good idea. Okay, so I'll be back at 7:15, and we'll jump back into the monetary unit sampling. Yeah, we can get through one of these tonight. Okay. I was talking to myself for a second there. So what we're going to do is kind of put this all together. This is a monetary unit sampling. This problem, almost verbatim, has shown up on the CPA exam at least twice, and some different variations of it have shown up more than that. But this is actually this was actually a CPA exam problem. And I think I told you that the CPA exam was an open exam. The CPA exam was an open exam up until 1996, which I know was like before you guys were born. But before that time, you would actually, they give you the exam, they give you an answer sheet. And when you finish the exam, you would hand in the answer sheet. And then the exam, you'd hand it to them and they put it in an envelope. And when you're done with the CPA exam, about a week later, they mailed it to you. You'd actually have the exam. So a lot of times the actual CPA questions were used. And for a lot of the new accounting rule, auditing rules, you're not going to find CPA exam, actual CPA exam questions. But for old things like sampling hasn't changed in 50 years or more. So for things like there are actual CPA exam questions, and this is actually a CPA exam. So it was a CPA exam question that was on the CPA exam. Okay, so we're going to go through these. And most of these, so here we found these three misstatements. So here's the book value. Here's our incorrect acceptance. We found three things that had errors. And of these three things, two of them are well behaved, one of them is not. Okay, the first one is okay. The audit value is 8,000. They said it was worth 10,000, so this was an overstatement. We're going to multiply it by 50,000. So 8 divided by 10, 80%. Okay, so the projected value is 40,000. We're more interested in the misstatement, which is 10,000. And by the way, that has nothing to do with this 10,000. It's just an unhappy coincidence. So the projected misstatement for that first one is 10. All right, how about the second one? What's the projected misstatement for the second one?
20,000.
I think that's a projected value.
Oh, projected value. Yes, I'm sorry.
Yeah, I did that out of order. So the projected misstatement is what, 30?
1,000.
And number 3 is actually a quirky one. What's different about misstatement number 3?
The projected value is more than interval. It's more by 2,500.
Yeah, it's an understatement. This is an understatement, and this is one of those weird little rules that we have from up here. If it's an understatement, we ignore it, which as an auditor, you cringe at that. So we're going to ignore it. And the projected misstatement is 0. There is no misstatement. We'll worry about this incremental allowance later. But right now we're going to do this the projected misstatement is 10 plus 30, it's 40. thousand. Oops. I'm gonna bold this whole thing. Okay. So this is our best estimate as far as what the financial misstatements are misstated by. Now, I have got to go to a different calendar. So I'm gonna talk about these other two, these basic precision and this incremental allowance. And to do that, I need to, nope. Sorry. There we go. All right. So it's a ruler. I don't need it. Oh, an index card. Here we go. Okay, so this sort of looks like this. This is not going to be done to scale, but the client says that the client says that the book value is 6 million. 6 million. Okay, so this is what the book value is. The book value is 6 million. Okay. Now, what we're saying is we think that this, our best estimate is that this is overstated by 40,000. So this is our projected misstatement. There's a chord in my picture. Is 40,000. So we're saying that this is off by 40,000. That's our best estimate. Now, normally you have a bell curve, it goes both sides. In this case, we only are looking for overstatements. So the bell curve is only going to have it on one side. This is a one-tailed test. And it'll look like this. It could be off by more because this is a sample. So this is our projected misstatement. So it could be off by more than the 40,000. This is the 40,000 that it's off by, our best estimate. There's going to be two things that go into this. There's going to be the basic precision. And there's also going to be something called the incremental allowance. And we're auditing this to what level? 5%? 5%. So at the 5% level, this is what we're looking at. So we're going to have rejected misstatement, but it's a sample. So it could also be off by more because this is a sample of it. Basic precision is if there are no misstatements. We'll have basic precision. If there are misstatements, that indicates there could be more things that are misstated that will go into the incremental allowance. So the more misstatements you have, the higher this incremental allowance will be. The basic precision is just based on if there were no misstatements. And this one is if there are misstatements. Okay, so let's see how this thing works. Wrong document. Another wrong document. There's the document we're looking for. Okay, so calculate the basic precision. Okay, so we're going to come down here to our table. Uh-oh. I apologize. This is messed up. Does your look like this?
Yes, the same way as your document looks like.
Wow, how did that happen? Okay, they're both like that. Why? Oh, no, what am I doing? I'm being silly here. This is right. You know what? This table should actually be up here. This is the table. This is this table. The table that we need is here. Oops, let's not do that. Okay, so here's a table, the risk of incorrect acceptance. I know what I'm missing. The formula. I'm going to copy this up here. Basic precision. This is the last thing on the handout, basic precision. I'm going to move this up to where we are. So that's a big giant thing. Okay, basic precision. So this is going to equal our interval. Okay, so what's our interval?
$50,000.
Yep, here's our interval. Let's make this green so we know what it's for. Okay, so our interval is 50,000. And the reliability factor,
Three. 5%, zero misstatements, that's 3.
yep. Very good. So our risk of incorrect acceptance is 3. And now notice this is for 0 misstatements. If we don't have any misstatements, this is what we're going to use for this factor. So this would be times 3. agree? I did. And I'm gonna put it over here, equals 150,000.
Yes.
So this will be our basic precision. And again, this is if, oops, let's get one more zero on that. This is if there are no misstatements found. We would still have, because this is a sample, there's still a risk that it's off by more. Make this yellow. And maybe I should make that green. Color coordinate these. Ooh, I think I might be able to do this on the. I don't have a turquoise one. Yes. I don't have a yellow one either. How do I do it? Okay, so I'm going to go to my this thing. So our basic precision is 150,000. So this could be off by 150,000, and that's if there were no misstatements. So this is our basic, our projected misstatement is, you can't even see that. Sorry. This is if there's no misstatements. That could be up by another 150,000. We'll leave it, it'll make it worse. So our best estimate, 40,000. However, it's a sample. So it could be up another 150,000 at the 5% level just because it's a sample. Now we have some additional misstatements we have to take care of. Okay, so let's see here. Now for the really irritating part of this, the incremental allowance. Incremental allowance is there because it's the idea that the more misstatements you have, the more likely you have more of them. If you do find misstatements, that there's a possibility these could be off by even more, even more money because they don't. If you take it by this sample, when you find misstatements, there is also the likelihood there could be more in the sample. And if you look at these book values compared to the intervals, on this one, they're pretty well behaved. They're all less. This one doesn't matter down here. So in other words, the book value here is 10,000. So there's another 40,000 hanging around in this interval that could go wrong. For number two misstatement, 4,000 was misstated. So there could be another 46,000 worth of dollars in there that could be misstated by more. So these two could both be worse than they really show because now we know that there is a possibility of misstatements. So are these included in incremental allowance? These first two are. We'll make them turquoise. Now this one's not a misstatement at all, so it'll be a no. Even if it was down there, if you multiply 0 times anything, it'd be 0. So don't do that. Okay. So these two are going to be included in incremental allowance. Now for the really wacky part that is really irritating. So get ready to be irritated. I'm irritated already, and I know what's going to happen. Okay. So what we're going to do is go to the incremental formulas from the liability table. So we're going to look at overstatement 1 minus overstatement 0. Okay, so this is overstatement 1, and we're going to subtract from the overstatement 0 of 3. So 4.75 minus the 3. So I'm going to put this in our formula. 4.75. Oops. I'll tell you why I'm mad about this in a second. All right, so 4.75, 3. I think that one's green. Minus 1, so 1.7. I think it's going to have to be just 0.75. So this is the incremental factor. We're going to do it for the second misstatement. We're going to figure out what the incremental factor is, just because we're in that vein now. So we're going to take the overstatement 2 versus overstatement 1. So here's overstatement 1. I'm just going to copy this down to here. And we got to go down and find, oops, go down and find overstatement 2. $630. So if we go from 0, so this is basic precision is 0. If we have an incremental allowance, if we have one misstatement, we go to that first level and find the incremental allowance, the incremental over it. And if we have two misstatements like we have, we're going to go to the second one and say, okay, the incremental over this. So what is it? 6.3. Minus 4.75 minus 1.55. I'm going to make that blue also. Okay. So we have two incremental factors. If we had a third misstatement, we could do a third one, but we don't have a third one, so we'll leave that blank. So the largest misstatement first. So now we got to go to our misstatements. And which one's the largest?
30,000.
Yep. So this 30,000 misstatement, I'm going to copy that. And then the next misstatement will be the next smallest, which in this case is just the 10,000. That's the only other one we have. And then we're going to multiply them by these incremental factors. Was it 22,500? Yep, that's 22,500. And 0.55 times 10,000 is 5,500.
Yes.
Okay, so this is going to be our incremental allowance. Okay, so if we add all these up, man, do I hate the way I laid this thing out. Okay, so if we add these up, so 22,500 plus, I'm going to put it over here. Plus 5,500. You can do it anywhere you put it on here is fine. You go, what is it? 27, 28,000. So this will be 28,000. I'll tell you why this irritates me. It would be so easy. Like if I ever wrote a auditing textbook, I would just put an incremental factor table in. There's no reason why this could, these are going to be the same. The incremental table at 5% would be 0.75. You just look it up on the table, 0.55. It'd be real easy to make one of these just for incremental allowance. You wouldn't have to do all this wacky math in there. But okay, so this could be off by another 28,000 because we know there's errors or misstatements, and those misstatements mean there's a possibility that there's more. Find one misstatement, that means it's possible, and there could be more. Okay, so going back to this thing, the increment fuzzies on my thing. So the incremental allowance. So this is 150,000. Our rejected misstatement is 40,000, and the incremental allowance is 28,000. So this could be off by another 28,000. I know this isn't to scale, but so I don't have a blue marker. I have a purple one. I already had a blue marker. My desk is a mess right now. I've been working on motorcycles. It's filled up with screwdrivers. Okay, so anyway, so this is the incremental allowance. So 40,000 plus 150 plus 20. So this is the upper limit. And we'll get a number for that in a second. Okay, so yeah. So all three of these together will give us the upper limit. What is that? 190, 218? So this would be our upper limit on the misstatements. That this could be off by as much as 218,000 at the 5% level. Oops. Our best estimate is it's off by 40. However, this is a sample, so it could be off by another 150 for the precision and 28 for the incremental allowance. The upper limit, this could be off by 218,000. And again, I apologize for the spacing here. I'm not sure what I was. What do I get rid of this thing? Good shit. Ooh, it comes close. Okay. All right, so this is our upper limit. So the upper limit of this would be 218. This would be the end of it. So this would look like this. Our best estimate is that it's off by 40. However, because of this is a sample, so even if we had 0 misstatements, it would be off by another 150. It could be off by, we do have misstatements, so the incremental allowance is 28,000. So the upper limit is 218,000. And so this is what you would compare to the book value to see if it was material or not. Is this material? That's a judgment call. we should all get the same number, but whether it's material or not is up to the judgment of the senior, the manager, the partner. So this is 200, and this is out of what was it? 6 million or something like that? Okay, so $6 million. It's off by up to 218,000. So you have to make a decision whether that's material or not. Someone might say it is, someone might say it's not, but the 218 is what we should get. And the sacramental allowance thing is, like I say, I wish they just showed a table for it. And you say, well, wait a minute, you're teaching this class, couldn't you just give us a table for that? I could. The problem with me, well, first of all, my problem with showing the wrong camera. The problem with me doing that is that they're not going to show that on the CPA exam. You know, yeah, I can make a table. I can easily make a table that shows the incremental amounts. But you might need to know that because you take the CPA exam and they give you this, reliability factor table. And all of a sudden you got to do it for yourself. So you might as well learn it now in case they give you that table. And then you subtract them and then -1 and then multiply it by whatever the highest misstatement and in descending order the level of misstatements. So part of the reason why I don't just make an incremental table, which would be very easy and really speed this up, is that you're not going to see it like that. At least I didn't see it like that. I haven't seen it on the CPA exam. I'm just giving you an incremental amount. Any questions? There's enough. I apologize. I thought I was going to get done with the handout tonight, but so I'm going to do. Let's see here. Okay, we are not going to finish this. I'll leave this for next week. Next week, this will be true. I won't be lying to you next week. And I'm going to back this up. This will not be due till October 32nd, or as we like to call it, November 1st. So I'll change that in there. But any question on that? And unfortunately, nothing to turn in this week. I apologize. I really thought I was going to get that one in. I don't know what I was thinking. But I'd rather spend more time on these 3, 5, and 6 are the big chapters. That's probably, I don't know, 40–50% of the auditing section of the CPA exam. So even though, yeah, it's like slogging through mud, trying to get through it, at the same time, it's a huge amount. The bang for the buck is really big. If you take extra time on the classes, those are probably well worth it. Okay, any questions? Well, enjoy your auditing free weekend, and I will see you guys next week. Okay.
See you next week, Professor. Thank you.
Good night. Good night, guys.
Good night.
Good night.